What's up, guys? It's your boy Authentic FX here, back for our fourth episode, sorry, on mastering the art of smart money trading. Welcome to our May Premium YouTube mentorship program, guys. As we're about to get into the video, please drop a like and comment, and please don't forget to share and subscribe, guys. Today's lesson will be on institutional patterns. Basically, what we are going to be looking for is how these patterns are found and how we break them down and use them to trade, right? So to identify institutional patterns, we need to understand how these patterns are formed. It all starts with understanding market structure, right? So understanding our highs, higher lows, and higher highs, guys, and your lows, lower highs, guys. And the whole concept of this is to ask ourselves what's going on behind the scenes, right? We're trying to break down what's going on behind the scenes. Why does market structure tend to have a high, low, higher, high, and a quick sudden shift to the downside? This pattern is called the breaker. It This is the first institutional pattern that we will be speaking about. The market will basically create a higher high, right? Then fail to go higher, creating that third expansion. So as you can see, we've got our first expansion to the upside, retracement, second expansion, but we failed to create that third expansion. Excuse me. Third expansion, right? Followed by a break to the downside. The failure at that higher high that has been created is defined as a rejection at the highs in terms of a sell model. So this is when price suddenly starts to sell off in the market at this higher high. So vice versa with a buy side model, we can clearly see that we've created that low, created that lower low, right? At this lower low, we fail to create a third expansion to the downside. Instead, we break price to the upside, taking out the swing high, right? So now the question is, how do we know which side we are on the market? Are we still selling, or are we changing our model to a buy, right? And why does the market shift so suddenly at that level? That's the question we need to ask ourselves. So usually when price takes out a previous high or a previous low, right, that basically means that within this area there is a area of resistance, right? In terms of resistance and support, in smart money concepts, we look at it as a order block, right, or a fair value gap, or old high or old low, and sell and buy stops. So usually what will happen is we'll see price gravitating to the upside, we'll see a sudden shift to the downside, and people who get in the sell will suddenly get kicked out on this push. So usually when it comes to retail methods, this is called a stop hunt for price to reprice itself down or reprice itself all the way back up to the upside, even though someone was in a buy or sell, right? What price will be seeking is the area of resistance or support, also known as an order block, or supply and demand zone, or old high, to take out old high or old lows and sell stops, right? So it's very important to basically identify these certain trends, right? So as you can see within this buy model, we can clearly see that price has been targeting sell stops within this expansion, coming into old lows, taking them out and taking out sell stops to reprice itself up, right? Or to take out buy stops or old highs and reprice itself to the downside, guys. So now what we pay attention to after this move is expecting this break of structure, right? The break of structure. Because why is it a breaker, right? It is a breaker because once price takes out the short-term high, then the low, it indicates that the market makers targeted individuals that sold and trapped them, right? So individuals that sold on this leg were trapped now within this move, and now they reprice price back down to the downside. The market trades to a key level, right? So for example, the people who were in the sell sold at a key level, right? Or just short of it, but failed to immediately react, right? Indicating another run before a reversal. So once the market pushed up into this key level, you can see the market failed to react, basically creating a new break of structure at these lows. Instead, it quickly ran higher before it reversed, right? In terms of a buy model, right, we can clearly see that price was selling off, right? We were selling off to the downside. Price got into the zone, right? And then from there took out the short-term highs, and then from there repriced itself higher, guys. From this key level, the people who were in buys here get taken out lower, right? For price to just push all the way up again, right? So basically what we're looking for, right, once we have taken out the people who were in buys or the people who were in sells, we have to look at two things, right? Market structure has been broken down, and the retracement will provide new selling and buying opportunity. So as you can see, we've got old highs or buy stops resting. We've taken out the old low, right? And now we can say that, okay, cool. Price is repricing higher after sell stops are taken out. So this move to the downside is taking out sell stops to the left, right? We can clearly see that now after we reprice to the upside, now from targeting sell stops, the rally on buy stops occurs, right? Indicates that sellers are trapped long. So those people who have been selling are now trapped in this buy move because now the market has either taken them out or induced them into adding more sell opportunities. Vice versa with the sell side model, we can clearly see we've had sell stops to the lows and old lows, right? The market rallies up to a key level. People start selling at this point, right? And then from there, notice now this move to the upside on this buy side trade. Price is repricing lower after buy stops are taken out. So this move was targeting buy stops to the left, right? Once you've taken out those buy stops, notice how price quickly pushes down to the downside. The rally on the sell stops indicates that buyers are trapped short. So everyone that has been buying in this whole entire expansion is now trapped because why? The market makers are basically taking their stops, right? And then those who actually got in on this retracement for buys are also trapped within the buy, within that short, right? So that is basically the market structure, which has been broken down, and the retracement will provide new selling and buying opportunities. So after this reversal, guys, right, the whole concept is to enter on the low or the high that price broke, right? The most recent low or high that price broke, right? The opportunity is best taken when the short-term market structure breaking points are retested. This creates an optimal trade entry to continue the directional bias. So now we know that we've hit our area of interest. So if you fail to enter on this area within either order block or fair value gap, or when price takes out old lows or highs, we can clearly wait for price to create that push to the upside, breaking structure, taking out that old high or buy stop, and then enter once price revisits, right, that area of interest or that short-term market structure breaking point, which is here. In terms of a sell model, we wait for a break of structure and price to re-enter with our entry just at the low, stop loss above. The reason why we put our stop loss above here or below here is because now we know that now the market is not looking to come and take out this high, as it's already taken out this high. That was their main objectives, to take out this high. So we will have a safe stop loss within these highs or these lows, and then from there continue the trend. What is a bullish and bearish breaker block, guys? Right? So basically, a bullish breaker block is created within that model. As you can see, we had price channeling to the downside. We've taken out an old low, and now the swing high is the one that's taken out next. We wait for price to revisit that old swing high to continue the bias or direction. A bearish breaker block is basically a bullish range, right? So as you can see, these are bullish candles, or a closed up candle, right? A bullish closed up candle, which is this candle here, in the most recent swing high. So this is the most recent swing high because this high created this low, right? Prior to an old low being violated. This was the old low, this was the swing high, this was the new low created. So prior to the old low which got violated, the buyer that bought this old low, so from this old low, the person who was in this buy, right, or the traders that were in this buy, later find out that they get kicked out, right? And then see the same swing high, right, being violated, will look to mitigate their losses, or regain some profits, right, when price returns. So they will usually get in on a sell when price returns back to the swing high, just for price to come back to the swing high and continue its move to the upside. So what you will clearly see is a push to the upside, creating a new swing high, and then price will gravitate back to this bullish breaker block. Can you see price mitigates it and suddenly shoots up, right? This is the whole concept behind the pattern that we are learning, which is a breaker block. So we first see the breaker, which is this move, and then price will leave behind a breaker block, which is a bullish up close candle, and price will come into it and then gravitate to the upside. What is a bearish breaker block, right? So a bearish breaker block is basically a bearish range or down close candle in the most recent swing low prior to an old high being violated. So this is the most recent swing low. This is the old high which got violated. This will be the last down candle or bearish, right, range that created that push to the upside. The seller that sold this old high, so the seller that was in this old high, will look to regain profits, right? Once he sees price taking out the swing low, they will look to regain profits by actually buying into the swing low, just for price to carry on gravitating to the downside, right? This is a trade setup with considering in terms of a bearish setup, guys. So where do we have our entry points? So right now we can clearly see that this short-term low, price breaks it, right? This is the breaker, and then gravitates to the breaker block. As you can see, this candle wicks within it, right? So our entry will be at the beginning of this breaker block, and we can put our stop loss just at the highest of these areas here, or at the high of this candle that created the breaker, right? This imbalance candle that you see here. And then from there, just for price to enter, sweep these equal highs here and gravitate to the downside, guys. So it's all about patience and seeing how the market will react when it gets into our zone. The aim of this is to make sure that price taps in to our zone and then quickly expands or rejects, guys. We are not looking to enter at these lows here because price has not entered our area of interest. Notice now, when we enter these area of interest, look at the spikes in the reaction. This shows us that the market is willing to reprice higher or lower, guys. So that is the lesson for today on the institutional pattern called the breaker slash the breaker blocks. The trend is your friend, guys, until it stabs you in the back with a chopstick, guys. So just remember that not all the time will this saying of follow the trend apply to trading. The market varies. You need to be able to spot these setups at all times. And these setups right here, I swear, guys, like if you could find these setups every single day in the market, you could profit a ton and literally just use the strategy to get to where you need to go, guys. This is a very profitable strategy. I swear it plays out every session, every day. Not every session, but it will play out in one of the Asian or London or New York sessions within a given day, guys. So I hope you enjoyed the video for today. I know it's quite short, but that's a wrap. I'll see you guys tomorrow for episode 5. Please don't forget to like, comment, and subscribe. And please, guys, share the video, as I am taking time out of my day to share these contexts with you. It is your boy Authentic FX, and I'm glad that you are here. See you tomorrow. Bye.